Is an FHA loan actually a good deal in 2025? That's the question a lot of buyers are asking, especially with interest rates still elevated, prices staying high, and so many loan options out there. FHA is still one of the most popular ways to buy a home, but does it actually make sense right now? In this video, I'm going to walk you through the exact situations where FHA is still a smart move and when it might actually cost you more than you expect, because just qualifying for a loan doesn't always mean it's the best fit. Just to make sure we're on the same page, FHA loans are backed by the Federal Housing Administration. They don't lend money directly, but they insure the loan, which allows lenders to be more flexible with buyers. You only need 3.5% down if your credit score is at least 580. If your credit score is between 500 and 579, you might still qualify, but you'll need to put 10% down. The loan has to be your primary residence. You can't use FHA for second homes or investment properties. One of the biggest benefits of the FHA loan is the lower credit score requirement. Most conventional lenders want to see at least a 620 credit score, and to get the best rates, you're usually looking at 740 or higher. But with FHA, if your score is 580 or better, you can still just put 3.5% down and qualify. And even if your score is in the low 600s, FHA might still give you better terms than conventional. This is based on your FICO credit score, not what you see on Credit Karma or similar websites. Your credit card or bank might show you your actual FICO score, and that's the one lenders care about. The down payment requirement is another big win for FHA. Just 3.5% down is much more manageable than the 5 or even 10% that's often put down for a conventional loan. And here's where it gets interesting. You can use gift funds for your down payment. FHA allows gifts from family, employers, even some nonprofits. And on top of that, down payment assistance programs often pair really well with FHA loans. In the right situation, you might be able to cover your entire down payment and sometimes even your closing costs with assistance. Another huge benefit of FHA is the more flexible debt-to-income ratio, or DTI. If you're not familiar, DTI is how much of your gross monthly income is going toward debt. There's your front-end ratio, which includes just your housing costs, your mortgage, taxes, insurance, and HOA if you have one. And then there's your back-end ratio, which includes all debt, housing, car loans, student loans, credit cards, personal loans, child support, all that kind of stuff. It doesn't include bills like your phone or electric bills. FHA allows higher DTIs than most other loan programs. In some cases, they'll approve up to 47% on the front end and up to 57% on the back end. That's more flexible than conventional loans, which usually want to see no more than 36% front end and 45% back end. Now, just because FHA allows it doesn't mean every lender will approve it. This is where something called lender overlays comes in. Lenders can have stricter rules than FHA. One lender might approve you with a 580 credit score, another might want 620. One might be fine with 56% DTI, another might cap you at 43%. That's why it's so important to talk with multiple lenders. Shopping around isn't just about getting a better rate, it can literally be the difference between qualifying and not qualifying. I've got free resources on my website, workwithdang.com, including a homebuyer course, a quick start guide, and help connecting with agents if you need one. And if you haven't already, go ahead and hit subscribe. I make videos like this every week. Alright, let's talk about the other side of FHA where it can start to get expensive. The biggest downside is mortgage insurance. And with FHA, it doesn't just go away once you've built equity. FHA loans have two types of mortgage insurance. First, there's an upfront mortgage insurance premium, 1.75% of the loan amount. Sometimes it can be rolled into the loan, but it's still part of the cost. Then there's monthly mortgage insurance called MIP, which is usually about 0.55% of the loan amount per year. That's added to your monthly payment. Here's the catch. If you only put down 3.5%, the monthly MIP stays for the life of the loan. The only way to remove it is to refinance into a conventional loan later on. If you put 10% down up front, the MIP drops off after 11 years, but most FHA buyers aren't in that category. So even though FHA offers a lower base interest rate, once you factor in the mortgage insurance, your real monthly cost can be similar or even higher than a conventional loan. Let's say FHA rates are around 6.25% right now, and conventional loan is closer to 6.75%. The FHA rate looks better at first, but after you add the 0.55% annual MIP, your effective rate might be closer to 6.8%, which puts you right back in line with conventional. That's why I suggest you don't just look at the rate, look at the total monthly payment. That's the number that really matters. Now remember, with conventional loans, you do have mortgage insurance as well if you don't put down 20%, but once you have 20% equity in the home, then the mortgage insurance can be removed. Another downside of FHA is the stricter appraisal requirements. FHA appraisers look at both value and condition. If they see exterior peeling paint, broken steps, missing appliances, appliances, anything that impacts safety or livability, they'll flag it. And if the seller won't fix it, the deal could fall apart. That's not unique to FHA. USDA and VA loans are similar, but conventional loans don't have those same standards, which can make them easier to use in competitive markets where sellers don't want to deal with repair requests. FHA also has lower loan limits in many counties. These vary by location, but they're usually lower than the limits for conventional loans. So if you're buying in a high-cost area, FHA might not be enough, and you'll have to look at conventional or even jumbo loans instead. Let's talk about equity. With FHA, you're starting with just 3.5% down. That means very little equity right out of the gate. If something comes up and you need to sell the home in a year or two, you may not have enough equity to cover the costs of selling. Between real estate commissions and closing costs, you could end up underwater, owing more than what the home is worth. And here's something that doesn't get talked about enough. Because FHA is so flexible, lower credit scores, higher DTI, it becomes really easy to qualify. And sometimes people use that flexibility to stretch way too far. I've seen buyers approved with 56% DTI, and personally, I don't think that's a great idea. That means more than half of your gross income is going toward debt every month. That doesn't leave much room for savings, emergencies, or even just living life. So just because you can get approved doesn't mean it's the right move. A lender's job is to say yes or no based on the guidelines. They're not going to look at your long-term financial goals or the fact that you're planning to buy a car next month. You have to look at your full picture and ask yourself, does this actually make sense for me? Now let's flip it around. When is FHA actually a smart move? It's a great option if your credit score is under 680, especially in that 640 to 680 range. In that range, FHA usually gives you better rates than conventional, and the mortgage insurance on conventional loans tends to be more expensive if your credit isn't excellent. It's also ideal if you only got 3.5% saved and you're not going to be able to save more anytime soon. FHA gives you a path to home ownership without needing 5, 10, or 20% down. And if you're planning to stay in the home for a while, you'll build equity and eventually you can refinance into a conventional loan if it makes sense. A lot of down payment assistance programs are built to work well with FHA loans, and because FHA allows gift funds and flexible guidelines, it's easier to layer those tools together. But FHA is not always the best deal. If you've got pretty good credit, let's say 700 or above, and you've saved 5 to 10%, you'll probably get a better monthly payment and better long-term terms with a conventional loan. You can cancel PMI once you hit 20% equity. You avoid the lifetime MIP, and sellers tend to view conventional buyers as stronger financially, which can help you in a competitive market. FHA also might not be ideal if you plan to refinance quickly. That 1.75% upfront mortgage insurance premium can get rolled into your loan, or you pay it upfront, and you're not getting that money back. So if you know you'll be refinancing in a year or two, FHA may not make much sense. So is FHA a good deal in 2025? If your credit score is under 680, your savings are tight, and you're planning to stay in the home long term, then yes, it can absolutely be a good deal in 2025. FHA gives you flexibility, lower credit requirements, and options that conventional loans often don't. But if your credit is strong, you've got at least 5 to 10% saved, or you're hoping to refinance or move in the next couple of years, conventional might save you more money over time. You'll likely get a lower monthly payment and avoid the long-term cost of mortgage insurance. This isn't about one loan being better than the other across the board. It's about knowing where you are financially and choosing the loan that actually fits your situation, not just what you qualify for on paper. FHA is still a powerful tool when used the right way, but in 2025, with affordability being such a challenge, the best deal is the one that balances your short-term needs with your long-term goals. If you want to learn more about FHA loans, check out the next video. And if this helped, please like, comment, and subscribe. It really does help the channel grow, and I appreciate it.